Before taking any trade on a live account, you should know exactly how much you're going to have to pay your broker for opening and closing that position. That is your transaction cost. And you should aim to keep this cost at least under 5% of the gross P&L, or ideally under 2.5%. Knowing this is actually more important than your trading strategy. Because even if you manage to execute a strategy flawlessly, if you're paying too much in commissions, you'll end up losing money. So let's look at an example to better illustrate this. Let's say you're trading one contract in the Micro E-mini S&P 500, where 1 point is worth $5. If you were to use a 1 point stop loss and a 1 point profit target, in theory, you would either make $5 or lose $5, which would be a 1-to-1 risk-reward ratio, right? Well, in real life, you have to pay for every trade you take. So, you did your research and you found out your broker charges $1.24 per round turn on the Micro E-minis. Once you add this cost to the equation, you can quickly tell it makes your profits smaller and your losers bigger, affecting significantly your risk-reward profile and making it much worse than the 1-to-1 you thought you had initially. In this case, the transaction cost is around 25% of the gross P&L, which is extremely high. You should never trade if your cost structure looks like this. Remember, you want to keep this cost below 5% or ideally below 2.5%. Now let's look at example number 2, where you have realized that the previous cost structure was very bad, so now you're aiming for a 10 points profit target using a 5-point stop loss. Of course, now you know that your real risk reward is not going to be 2-to-1, but at least it's not going to be affected nearly as much as in the previous example. After commissions, your profits will be around 2.5% smaller and your losses around 5% bigger if you get stopped out. While this is acceptable, you can still make it better. So let's look at example number 3. Here, you decided to use a 20 points target and a 10 points stop loss. As you quickly realize, the transaction cost is now very small compared to the distance of the take profit and the stop loss. Now the transaction cost will only be around 1.2% of a profit and 2.5% of the loss if you get stopped out. With a cost structure like this, you have a way better chance of replicating backtesting results when trading real money. So now that you know the importance of accounting for your transaction cost, here are some options you have to improve it. First, you can look for a better broker for you with cheaper commissions or maybe a different account type. Some brokers offer different account types with different fee structures, so you have to do your own research on this and find the one that's best for you. Second, you can also trade on a higher time frame. This will allow you to use a larger profit target and usually would also require a wider stop loss, which would reduce the impact of transaction costs in your risk-reward profile. Third, trade a different market. Sometimes the transaction costs can vary a lot from one market to the other, so it's always a good practice to compare which one offers the most convenient structure for you. Make sure you clearly understand what your transaction cost is and that you can use it to determine the minimum profit targets and stop loss size that will allow you to maintain a reasonable cost structure.